That way, everyone will be able to.
Today, we raised the policy interest rate by 50 basis points to 3.75%. This is the sixth consecutive increase since March, and quantitative tightening continues and is complementing increases in the policy interest rate. We also expect our policy rate will need to increase further. How much further will depend on how monetary policy is working to slow demand, how supply challenges are resolving, and how inflation and inflation expectations are responding to this tightening cycle. Our decision today reflects several considerations. First, inflation in Canada remains high and broad-based. Inflation has come down in recent months, but we have yet to see a generalized decline in price pressures. Second, and related, the economy is still in excess demand. It's overheated. Households and businesses want to buy more goods and services than the economy can produce, and this is driving prices up. Third, higher interest rates are beginning to weigh on growth. This is increasingly evident in interest rate-sensitive parts of the economy, like housing and spending on big-ticket items. But the effects of higher interest rates will take time to spread through the economy. Fourth, there are no easy outs to restoring price stability. We need the economy to slow to rebalance demand and supply and relieve price pressures. We expect growth will stall in the next few quarters, in other words, growth close to zero. But once we get through this slowdown, growth will pick up, our economy will grow solidly, and the benefits of low and predictable inflation will be restored. Finally, we're trying to balance the risks of under and over tightening. La décision aujourd'hui reflète plusieurs considérations. Premièrement, l'inflation au Canada reste élevée et généralisée. Elle a diminué ces derniers mois, mais on attend encore une baisse globale des pressions sur les prix. Deuxièmement, la demande est encore excédentaire. L'économie surchauffe. Les ménages et les entreprises veulent acheter plus de biens et de services que l'économie peut produire, et ça fait monter les prix. Troisièmement, les taux d'intérêt élevés commencent à peser sur la croissance. C'est de plus en plus évident dans les dépenses sensibles aux taux d'intérêt comme le logement et les gros achats. Mais il faudra du temps pour que les effets des hausses de taux se transmettent à toute l'économie. Quatrièmement, il n'y a pas de solution facile pour restaurer la stabilité des prix. L'économie doit ralentir pour rééquilibrer l'offrir et la demande et réduire les pressions sur les prix. Au cours des prochains trimestres, la croissance devrait être près de zéro. Mais après ce ralentissement, la croissance va se redresser. L'économie va progresser fortement et le Canada va de nouvelle bénéficier d'une inflation bas et prévisible. Enfin, la Banque essaie de mettre en balance les risques d'un resserrement trop faible ou trop fort. If we don't do enough, Canadians will continue to endure the hardship of high inflation. And they will come to expect persistently high inflation, which will require much higher interest rates and potentially a severe recession to control inflation. Nobody wants that. If we do too much, we could slow the economy more than needed. And we know that has harmful consequences for people's ability to service their debts, for their jobs, and for their businesses. This tightening phase will draw to a close. We are getting closer, but we're not there yet. We are carefully assessing the effects of higher interest rates on economic activity and inflation. And we are being clear with Canadians and focusing on the job we've been assigned to restore price stability for the benefit of all. Let me expand on these considerations and highlight the key points in the Governing Council's deliberations. Le Conseil de direction a abordé, le Conseil de direction a d'abord évalué la situation internationale depuis juillet. L'inflation est élevée partout et se généralise. La plupart des banques centrales ont relevé leur taux directeur pour maîtriser l'inflation, ce qui a causé un resserrement rapide des conditions financières dans le monde. L'économie mondiale ralentit et on a revu à la baisse notre projection concernant la croissance. Des tensions financières ont aussi émergé sur certains marchés ces derniers mois. Des indicateurs donnent à penser que les problèmes mondiaux d'approvisionnement diminuent. Les prix du pétrole et d'autres produits de base ont aussi baissé depuis juillet. La croissance plus lente dans le monde, combinée à ces évolutions, porte à croire que l'inflation mondiale devrait descendre au fil du temps. Cependant, l'incertitude est élevée, surtout en raison de l'invasion russe de l'Ukraine. Il est aussi possible que la volatilité augmente sur les marchés de l'énergie et que les problèmes d'approvisionnement recommencent. During the Canadian developments, the Governing Council devoted considerable attention to assessing inflation, inflation expectations, and the balance between demand and supply in the economy. Since June, inflation in Canada has come down from 8.1% to 6.9%. Though welcome, most of that decline reflects a drop in gasoline prices. Inflation in Canada is broad-based, reflecting large increases in both goods and services prices. About two-thirds of CPI components have risen by more than 5% over the last year. And rising prices for essentials like groceries and rent are hitting lower-income Canadians particularly hard. Short-term movements in total CPI inflation are often dominated by swings in volatile international prices like oil prices. That's why we're watching measures of core inflation closely for signs that price pressures in Canada are easing. Our preferred core measures have stopped rising in the last couple of months, but they have yet to show clear evidence that underlying inflation is coming down. Looking ahead, there are some early encouraging signs. Businesses have said they expect the rate of price increases for the goods and services they sell will come down. And more timely, 3-month rates of core inflation have declined, although they are still averaging about 4%. We're going to need to see these 3-month rates come down further and those declines be sustained. We are also looking for evidence that near-term inflation expectations are easing and that longer-term expectations are centered on our 2% inflation target. Near-term expectations remain high, and our surveys suggest that uncertainty about where inflation is headed remains unusually elevated. Looking at indicators of labor markets and economic activity, it's clear that even though the economy has started to slow, it remains in excess demand. Job vacancies have declined from their peak, but remain high, and businesses continue to report widespread labor shortages. With the economy now fully reopened, households want to enjoy many close contact services they have missed, but businesses can't keep up, and we have seen prices for services rise rapidly. Higher policy rates are beginning to slow demand. Higher mortgage rates have contributed to a sharp slowing in housing activity from unsustainable levels, and consumer and business spending on goods is moderating. This has led to declines in house prices and is exerting downward pressure on goods prices. Moving forward, we expect the effects of higher interest rates will continue to work through the economy, moderating household spending and business investment. Slowing global growth, particularly in the United States, will also weigh on Canadian exports. We project GDP growth will stall through the end of this year and the first half of 2023 before picking up in the second half. Annual average GDP growth is therefore projected to decline from about 3.25% this year to just under 1% next year and about 2% in 2024. With growth below potential for several quarters, excess demand in the economy dissipates and the economy moves into excess supply in 2023. Putting the global and Canadian outlooks together, we expect inflation will hover around 7% in the final quarter of this year, fall to around 3% by the end of next year, and return to the 2% target by the end of 2024. La Banque du Canada a pour mandat de maintenir l'inflation à un niveau bas, stable et prévisible. Mais on est encore loin du but. On juge que les risques entourant notre prévision d'inflation sont raisonnablement équilibrés. Mais comme l'inflation dépasse beaucoup la cible, on se préoccupe surtout des risques à la hausse. On sait que les taux d'intérêt plus élevés sont difficiles pour bien des Canadiens. De nombreux ménages sont très endettés et les hausses de taux viennent abordir leur fardeau. On ne veut pas que cette transition soit plus difficile que nécessaire, mais on reste déterminé à remplir notre mandat. Des taux plus élevés à court terme vont faire descendre l'inflation à long terme. Il faut traverser cette phase difficile pour revenir à la stabilité des prix et une croissance soutenue. The Bank of Canada's job is to ensure inflation is low, stable, and predictable. We are still far from that goal. We view the risks around our inflation forecast to be reasonably balanced, but with inflation so far above our target, we are particularly concerned about the upside risks. We are mindful that adjusting to higher interest rates is difficult for many Canadians, and many households have significant debt loads, and higher interest rates will add to their burden. We don't want this transition to be more difficult than it has to be, but we remain focused on our mandate. Higher interest rates in the short term will bring inflation down in the long term. And getting through this difficult phase will get us back to price stability and sustained growth. As we move forward, we'll be watching carefully to assess the impact of higher rates on spending and how this is feeding through to price pressures. We will also be watching to see how global supply disruptions resolve and to what extent this translates into lower inflation in Canada. Finally, we'll be watching inflation expectations closely to assess how households and businesses are responding to slower growth and spending. And with that, Senior Deputy Governor Rogers and I are pleased to take your questions.
Thank you, Governor Macklem. Just before we get going, if there are any reporters who have joined the call in the last few minutes and you want to ask a question, please send a brief email to communications with an S at bankofcanada.ca. We'll do our best to get you in the queue. That said, I've got at least 10 people here in the room and 3 on the line, so we'll need to be expeditious here. We'll go to questions now, starting here in Ottawa, and we'll go first to Mark Rendell of the Globe and Mail, please.
Hi, Governor Macklem. Thanks for taking my question. In the monetary policy report, you note it's as likely to see several quarters of negative growth as it is to see positive growth. Are you saying a recession is likely at this point, or a possibility at this point? And how is that, I guess, how have your assessments of a possible soft landing changed with the new update?
Mark, our mandate is clear. Our primary responsibility is to restore price stability. We have been raising interest rates rapidly to achieve that goal. And the other thing I would stress is by front-loading our policy response, we're trying to avoid the need for even bigger interest rates down the road and an even more pronounced slowing. As you mentioned, our latest outlook, we have growth stalling for the next several quarters. To be more precise, growth is close to zero in the fourth quarter of this year and the first 2 quarters, the first half of next year. What that does, what that means is that, yes, a couple, 2-3 quarters of slightly negative growth is just as likely as 2 or 3 quarters of slightly positive growth. That's not a severe contraction, but it is a significant slowing of the economy. And we certainly are seeing clearer signs that the economy is slowing. With growth essentially zero for the next several quarters, that will give supply the opportunity to catch up with demand, and that will relieve price pressures in our economy. Unfortunately, there's no easy out to restoring price stability. We actually need a period of slower growth to let supply catch up and relieve those price pressures. As we get through that period of slower growth, growth's going to pick up, economy's going to grow solidly, and we're going to have low inflation. So Canadians are not going to have to cope with the anxiety of high inflation.
Next up, we'll go to Raul from Epoch Times, please.
Thank you for taking my question. Given that the interest rate changes take 18 to 24 months to have full effect in the economy, basically, how will the Bank of Canada know when enough is enough? Like if you're looking at sort of backward-looking measures like currently reported inflation or even 3-month inflation trends, and given the embedded path of interest rate hikes that you have in the projection, we can see that inflation is supposed to get to 2% by the end of 2024. But is it all a model-driven thing that you will know when enough is enough, or it's kind of hard to say by looking at what measures are reported? So how can we get a better idea of when enough is enough in terms of interest rate hikes?
Okay, you packed a lot in there, but let me try to address your question. First of all, the way the transmission of monetary policy works is we raise interest rates, that slows spending, and then that translates into lower inflation. That relieves price pressure and inflation comes down. So we are going to be watching closely how the effects of higher interest rates work through the economy, and first of all, how they're affecting spending. We're already seeing clear signs that the interest rate increases that we've already done are having an impact on the economy. You've seen certainly contributed to a sharp slowing in the housing sector. You're starting to see purchases of bigger ticket items, things that are typically bought on credit. You're starting to see demand for those things slow. You've already seen house prices come down about 10%. It is going to take, as you highlighted, it is going to take some time for the interest rate increases we've put in place to work through the economy. We're going to be assessing how that works through, and we're also going to be watching closely for how that gets translated into low inflation. With respect to, is this an entirely model-driven exercise? No, it's not. Models are very useful, but models have limitations, and they have particular limitations when you're going through something that is unprecedented as a pandemic, and you're bouncing back and you're still dealing with the fallout of the pandemic. There's also a war in Europe. So these are not things that our models are well equipped to deal with. Models are certainly useful, but they need to be used with care. They also need to be supplemented with other kinds of information. So, for example, our Business Outlook survey, our surveys of consumers, they give another source of information. They can also be useful in giving more forward-looking information. One of the things I highlighted in the opening statement is when we went out and we asked businesses what they expect they're going to be doing with their own prices of the goods and services that they sell, they have indicated that the rate of increase of those prices they expect will come down. That is an encouraging sign. We're looking forward to seeing that in the actual inflation data.
Thank you. We'll go to Nojoud El-Malis of Canadian Press, please.
Hi, Governor. Before today, markets were a little bit torn between 50 basis points, 75 basis points. The bank opted for the smaller one. And I'm wondering if you could shed some light about that decision and why you didn't opt for a larger rate hike.
So, as you said, we decided today to raise the policy rate by 50 basis points. That is another larger than normal step. It's a big step. As I outlined in the opening statement, there were a number of reasons why a larger than normal step, a big step, was needed. Inflation's high, it's generalized. Even as the economy is slowing, it remains in excess demand, and that is driving prices up. The economy is slowing, but actually we need some slowing in the economy to relieve those price pressures. And if you look at inflation expectations, near-term inflation expectations are high, and there's a risk the longer they stay high, that starts to bleed into higher long-term inflation expectations, and then high inflation becomes embedded, and we can't let that happen. So for all those reasons, we needed we judged we needed a bigger than normal step. We are also seeing clearer evidence that the economy is slowing. As I just responded to a previous question, we have taken down our outlook for GDP growth in Canada. We expect growth will be close to zero for the next 3 quarters before picking up. What that will do is, with growth well below trend, that provides the opportunity for supply to catch up, and that will relieve price pressures. So coming back to 50 versus 75, at our previous 2 meetings, July and September, we increased by 100 and by 75. So coming into this meeting, interest rates were already considerably higher. Combine that with the fact that there are now clear signs that the economy is slowing, we judged that it was appropriate to slow the pace of increase in our policy rates from very big steps to a big step. Looking forward, we also indicated that we expect interest rates will need to rise further. So that suggests that, well, that could be another larger than normal step, or we may be able to move to more normal, smaller steps. We are getting closer to the end of this tightening phase, but we're not there yet.
Thank you. We'll go to Jordan from CTV, please.
Hi, Governor. Thanks for taking my question. The report says food and shelter inflation represents about 40% of the CPI. This especially affects low-income families. So what is your message to them today, given that you are signaling your tightening phase is not over yet?
The message to Canadians is, look, we know inflation's too high, and we know it's hitting you everywhere. It's hitting you shelter, rent, groceries. Roughly 2/3 of the components of the CPI basket, 2/3 of the things the average Canadian buy are going up more than 5%. That's hurting Canadians. That's why we're raising interest rates. By raising interest rates, we're going to slow demand in the economy, and that will relieve price pressures. We also know adjusting to higher interest rates is difficult for many Canadians. And we are assessing, we're watching that impact very closely. But unfortunately, there is no easy out to restoring price stability. We actually do need to slow the economy to relieve the price pressures. But when we get through this slowdown, growth's going to pick up, the economy is going to grow solidly, and we're going to have low and predictable inflation. That's the destination.
We'll go next to Paul Vieira from the Wall Street Journal, please.
Following up on previous question, is this a pivot from the Bank of Canada? Should we take this as maybe a pivot by the Bank of Canada that, as you said, very big or even big rate increases are now coming to an end, and we're going to have a return to more traditional quarter point increases given the economic forecast?
Well, we did 100, we did 75, today we did 50. We've signaled very clearly that we expect rates will need to rise further. That could mean another bigger than normal increase. It could mean that we can move to more normal size 25 basis point increases. We've been very clear on the things we're watching as we take those decisions, and it's going to depend on how the effects of higher interest rates are feeding through to slowing demand. It's going to depend on what we see in inflation and inflation expectations. And to some extent, clearly, inflation is going to be affected by international developments and how those global supply chains disruptions resolve.
Thank you. Next question will be Heather Schofield of the Toronto Star, please.
Morning. Governor, I'm wondering how you are assessing your credibility these days, and if that plays into your decision on rates at all. Do you have to raise rates any? Do you have to be more aggressive, I guess, now that in order to keep your credibility, now that you have politicians on all sides kind of questioning you?
Look, we need to do what we have to do. We have a very clear mandate. We're committed to achieving our mandate. We are trying to balance the risks on both sides. We don't want to under tighten. Inflation's not going to fade away by itself. And if we ignore the problem, if we're half-hearted in our response, inflation, Canadians will have to continue enduring high inflation. They'll have to continue to cope with the anxiety of high inflation. Nobody wants that. We're also very conscious, though, that if we over-tighten, the economy will slow more than is needed. That'll make life more difficult for Canadians than it's needed, and will undershoot our inflation target. So we don't want to do that either. These are difficult decisions. I will say that the independence of the central bank becomes more important when the decisions are difficult.
Bon, prochaine question vient de Olivier Ferron-Boissé du réseau TVA.
Bonjour, Monsieur le Gouverneur. Merci de prendre nos questions. Vous dites que vous voulez balancer les risques des deux côtés, mais tout de même, il y a des gens qui sont inquiets de devoir peut-être rapporter les clés de leur maison à la banque parce qu'ils ne peuvent plus payer leur hypothèque. Alors, comment vous assurez qu'une hausse supplémentaire n'est pas une hausse de trop? Quels sont les indicateurs qui vont vous permettre de savoir que votre approche ne devient pas trop agressive?
Oui. On est très conscient que les hausses des taux d'intérêt sont difficiles, surtout pour les Canadiens qui sont endettés. Les hausses des taux pour les hypothèques a déjà eu un effet marqué dans le marché du logement. Et on voit maintenant que l'activité a fortement baissé et les prix sont à la baisse aussi. On regarde de près ces ajustements. On est très conscient que l'ajustement et le taux d'intérêt plus élevé est difficile pour plusieurs Canadiens. Mais je veux souligner que l'économie est en demande excédentaire. L'économie surchauffe. Et l'ajustement qu'on voit dans l'économie et même l'ajustement qu'on voit dans le marché du logement, c'est un aspect de l'ajustement pour mieux équilibrer la demande et l'offre dans l'économie pour réduire les pressions inflationnistes. Donc, on regarde cet ajustement de près. On ne veut pas trop, augmenter les taux d'intérêt, mais on veut être confiant que l'inflation va retourner aux cibles. Ça, c'est notre mandat.
Merci. Our next question is Greg Quinn from Market News.
Good morning. Early this year, you and Senior Deputy Rogers, focused a bit on the Canadian dollar's depreciation, saying it boosted import prices and suggested maybe more action was needed on rates. I'm wondering if you could update us on where that stands now. I noted today's decision seemed to talk more about how the strong U.S. dollar is creating inflation pressures kind of around the world and not maybe specifically in Canada.
Well, maybe I'll bring Senior Deputy Governor Rogers in on this one since we both talked about it.
Sure. As you said, we've commented on this before. Our monetary policy framework assumes a floating dollar. The price of the dollar is set on the market. We have seen a sort of a break from tradition. Normally, if we saw elevated oil prices, we would see the Canadian dollar appreciate a bit. That would be a bit of an offset to inflation. That pattern hasn't held in recent months. We have seen currencies around the world depreciate against the U.S. dollar. The Canadian dollar has held up more than others, but it has depreciated. The forecast that we've put out today takes that into account. The Canadian dollar is assumed to be a bit weaker against the U.S. dollars. As you said, it'll feed through to inflation in the form of import prices. But it's built into the forecast that we put out today.
Thank you. We'll go now to Kevin Carmichael from the Financial Post, please.
I have a question about the conclusion in the NPR about how the assumption that supply chain disruptions and labor market mismatches were temporary, now assuming those are permanent. Could you talk a bit about what that means? I guess I'll ask the question this way. The central bank has re-upped its mandate, re-upped its commitment to the inflation target for decades now, based on the assumption that globalization and supply chain innovation is putting downward pressure on inflation. Plentiful labor supply putting downward pressure on inflation, or at least downward pressure on wage pressure. Your observation that things have changed makes me wonder if the target that we have in place is the right one. Could you talk about your confidence in the framework, given what we're seeing changing sort of in real time in the global economy?
I'll take the last part of your question first, Kevin. We've had an inflation target now for 30 years. And a lot has happened in the global economy over 30 years. We had the global financial crisis. We've had a pandemic. We've seen geopolitical tensions. We've seen changes in globalization. And through that whole period, the 2% target has served Canadians very well. So we do remain very confident that this is the right framework and that getting inflation back to 2%, Canadians expect us to control inflation. We're determined to do it, and we're convinced that our mandate is well aligned with what Canada and Canadians need. Now, with respect to sort of the more specifics around the assumptions we've made around supply, the way I would explain it is, as this pandemic has gone on for a long time now, and as new developments, war in Europe, new geopolitical tensions with China, what is becoming increasingly apparent is that supply chains are not just simply going to go back to the way they were before. Companies are adjusting. They are changing their supply chains. They're rather than focus entirely on the hyper efficiency of the supply chains, they are looking for more resilience in their supply chains. So we do expect that the disruptions that we're seeing in supply chains, we've already actually seen those ease. We expect they will continue to ease, and we're certainly looking for more evidence that that easing is passing through to companies in Canada. At the same time, we did change some of our assumptions, and we're not expecting that they're going to go back to the way they were before. The world has moved on. There will be some ongoing consequences.
Okay, next up, we're almost done here in the room. Next up, we have Julie Gordon from Reuters, please.
Hi, thanks for taking our questions. I just wanted to take the previous questions a little bit further, and I'm wondering if the considerations that you've outlined in your statement and in the rate decision mean perhaps you don't increase it all in your next decision and then resume in future decisions, i.e., are things becoming a little more data dependent now, or is it simply that the consideration is about the pace and scale of future increases?
I think I would be closer to your second characterization. I think we're pretty clear. We think rates need to go up further. We have indicated, I did indicate in the opening statement that, yes, this tightening phase will come to a close. We're getting closer to that point, but we're not there yet. So we do expect interest rates will need to go up further, and we will determine the pace based on developments going forward. And I think we've been pretty clear on the key things we're looking at.
Next, we have David George Kosh from BNN, please.
Hi there, Governor. I just want to speak specifically to the Chart 19 that breaks out CPI inflation in the Monetary Policy Report, and specifically the other factors designation that is defined as previously unobserved factors and factors that are due to underestimated demand pressures. That has been a significant contributor to inflation over the past several quarters, but the Bank of Canada forecasts that to ease completely by the end of 2023. How confident are you that these other factors, which again are attributed to previously unobserved factors, may actually ease? And if they don't, wouldn't they continue to keep inflation stubbornly high?
Well, this gets back a little bit to one of the previous questions. When you do this kind of decomposition, of course, you do need a model. And your models are imperfect and they don't capture everything. And so there are some parts that we can't fully model, but we do have other information on those parts. And this forecast really reflects that. Are there risks around this forecast? Yes, there are risks around this forecast. And I think in the last part of the NPR, we really outline two risks on both sides. Look, on the upside, global developments. Recently, we have seen some reduction in global energy prices. Global supply chains have been resolving, but there is a lot of uncertainty globally. We could certainly see renewed disruptions in the energy market and increases in energy prices. We could see new disruptions in global supply chains. I mean, the bottom line is, we cannot rely on global developments to bring inflation down in Canada. The other sources of upside risk closer to home, our own domestic prices, or particularly services prices, could prove stickier than in our base model. These service prices do tend to be sticky. We've built that in, but they could tend to be stickier. So there are upside risks. There's also downside risks. We did take our outlook down considerably with essentially zero growth for the next few quarters, but the outturn could be even weaker than that. That would put more downward pressure on inflation. So there are risks. Our view is that the chart that you see and the profile you see for inflation in Chart 19 is a reasonably balanced forecast with both upside and downside risks. But I would highlight, as I did in the opening statement, that with inflation so far above our target, we are more worried about those upside risks. So yes, we will be watching closely to see how these things play out. And if they're not playing out in line with our forecast, we'll have to take action.
Okay, and we'll go to Randy from Bloomberg, please.
Hi, Governor. With the Federal Reserve expected to move by 75 basis points next week, what is the scope for the Bank of Canada to diverge from the Fed?
Well, look, I'm going to let the Fed take their own decisions. We've taken ours. I'm confident that the Fed's going to do what's best for the U.S. economy, consistent with their mandate. We're focused on Canada. We're focused achieving our mandate. And one of the values of having an independent monetary policy with a flexible exchange rate is that we can run monetary policy for the needs of Canada and the needs of Canadians, and that's what we're doing.
Okay, I'm about to go to the phones. Before I do, I'm just going to give a glance over to the last outlet. Excellent, thank you very much. We've got 3 questioners on the phone then. We'll start with Craig Lord from Global News, please. Craig, are we there?
Yeah, we're not hearing anything here.
I'll circle back in a second then. Let's go to Pete Evans from CBC, please.
Thanks, Governor. Can you hear me?
You're pretty faint.
Yeah, if you could talk more loudly, it would be better.
Great. Governor, food prices have been top of mind for Canadians in recent months, and it's unfortunately also one of the parts of the economy that monetary policy has the least ability to impact demand or supply, given some of the forces at play. Can you tell Canadians why, if the first 5 rate hikes don't seem to have done much to ease the most pernicious increase in their cost of living, why this one or the next one is likely to do the trick at the part of their spending that's hitting them the most?
I'm going to ask the Senior Deputy to talk a bit about food prices. It's certainly top of mind for us.
Yeah, your question was a bit difficult to hear, but we know Canadians are concerned about food prices. There's a lot of focus on the contribution of increases in food prices to inflation. The bank is focused on it too. You'll see a decomposition in our monetary policy report on the things that are contributing to food price inflation. What we have seen is that food retailers, like other retailers, have seen rises in their input costs, and they have been able to pass those input costs through to consumers nearly 1-for-1. As agriculture prices have gone up, those have been passed through quickly. So food retailers' profit margins have held up. We've seen those input prices come down in recent months. Agriculture commodity prices have come down, so we will be looking to see whether the price declines will be passed through as well. We'll be watching for that quickly. The most important point we could make is that the environment that we're in, an environment of excess demand and high inflation, is the type of environment where retailers, including food retailers, are most able to pass through price increases to consumers. So our goal of getting the excess demand out of the economy, bringing inflation down, will help to restore the competitive pressure and will prevent retailers from just passing through all the costs. It'll bring the competition back. That'll put downward pressure on prices.
Okay, let's go to Kat Eschner from TVO, please.
Hi there, can you hear me?
Yes, very well.
Hello?
Yes, we hear you.
Great, thank you so much. Thanks very much for taking my question. What I'm wondering is, what evidentiary basis does the Bank of Canada have for its concerns about losing control of the inflationary narrative as happened in the 1970s? And before I ask, I'd like to refer you to the UN's most recent Trade and Development report. There was this quote that I thought was really interesting. Sifting through the economic entrails of a bygone era is unlikely, however, to provide the forward guidance needed for a softer landing given the deep structural and behavioral changes that have taken place in many economies, particularly those related to financialization, market concentration, and labor's bargaining power. In light of that, I'm just wondering if you can walk me through the evidence you're using to sort of make this assessment.
Well, if you compare the situation we have now to the situation in the 70s, there are some similarities. I think the things that are similar is inflation is high. It was high in the 70s. It's high now. The other thing, though, that is similar is that this inflation initially was driven more by sort of global factors. In the 70s, it was a huge increase in global oil prices. We saw oil prices move up, and then with the Russia's invasion of Ukraine, further moved up. That was certainly an important impulse to inflation. And the other thing that is similar between now and the 70s is that in the 70s and now, our economies are overheated. And simply put, households and businesses want to buy more goods and services than the economy can produce, and that's putting upward pressure on inflation. So there are some similarities, but as your quote highlights, there are some important differences. A lot has changed in the development of markets and the development of our financial system. since the 1970s. The other thing I would stress, though, is that a lot has changed in terms of our policy frameworks and our policy response. In the 70s, one of the big problems was we, and I mean sort of the world, had been on a system of fixed exchange rates. We abandoned the Bretton Woods system of fixed exchange rates, but we didn't replace it with anything. There was no monetary anchor. And what that meant is that central banks were a bit adrift, and there was nothing for markets, for people to anchor their expectations. Expectations of inflation became unmoored, and what we saw in the 70s is when that happens, it does take a severe recession to bring inflation back down. What's the most important thing that has changed this time is we have had a very clear monetary policy framework and inflation target for 30 years now. It is well understood by markets, by Canadians, and long-run inflation expectations have remained reasonably anchored on our inflation target. And I think that reflects the confidence that, yes, this is the biggest test the inflation targeting framework has had, but the confidence is there that we will control inflation and it will come back to our target. That's very different from the 70s. The other thing I would highlight that is different from the 70s is in the 70s, there was a long period of excess demand, a big buildup. This time, we've gone from the deepest recession we've ever had 2 years ago through the fastest recovery. Inflation has gone up very quickly as the economy moved, very quickly into excess demand. And as by front-loading our response, that is slowing spending, and hopefully that will bring, we will fairly soon start to see clear signs that underlying inflation is starting to come down. And that will reinforce everybody's confidence that inflation is going back to 2%.
Okay, I know we're close to the end, but I'm going to try to squeeze in the last two questions that we have. Craig, Lord, did you want to try again, please?
Hi there, can you hear me?
Yes.
Yes, we hear you well now. Thank you.
Thank you very much for coming back to me. Governor Macklem, you were speaking earlier this month in Halifax, and I believe you said then that the path to a soft landing is getting narrower. Since then, we've gotten new job numbers, inflation figures, a pair of business and consumer surveys, and the rate hike now. How do you rate that window for the soft landing at this point?
Well, as I indicated in Halifax, yes, the path has narrowed, and with a benefit, we now have a revised projection, so we can be clearer. We're expecting roughly zero growth for the next several quarters, and to be more specific, the last quarter of this year, the first half of next year. After that, we expect growth will pick up. So with growth close to zero for the next several quarters, it's just about as likely that we'll get some small negatives as we get some small positives. So we could see some contraction in GDP. We could see a very modest growth in GDP. What we don't expect is a severe contraction.
And we'll wrap it up with Tony Mace, please.
Hi, I'd just like to ask about the extent to which financial stability concerns or concerns about financial market liquidity had some bearing on your decision to opt for 50 basis points today, or whether it might have some implications for your approach to QT. Thank you.
I'm going to ask Senior Deputy Governor to take this question.
Yeah, we've seen financial conditions tighten significantly in recent months as central banks have raised rates to respond to inflation. Government bond yields have gone up. Prices on risk assets, equities, and others have repriced down. These sort of sudden and sharp moves have led to, in some cases, some signs of financial stress. What we saw in the UK over recent weeks was fairly unique to some conditions there, but these are the kinds of things we're watching. Certainly tightened financial conditions and higher interest rates are occurring against a backdrop of some of the vulnerabilities that we and other central banks have talked about for some time now, higher levels of indebtedness, some structural changes in liquidity. So certainly the conditions are there. We need to be vigilant about bouts of financial stress. Now is certainly the time to be vigilant, both central banks and market participants. It's something that we watch. There's a section in the NPR that outlines our current thinking on it.
Okay, and that will wrap up today's press conference. I want to thank Governor Macklem and Senior Deputy Governor Rogers for indulging us, letting us run a little long so that we could make sure we covered everybody and everyone had a chance to ask a question. Thank you all for coming. We'll see you next time.
Thank you.
Thank you.